Well, first and foremost, this is a very in the making research, and it's still missing many archival sources. It's basically based on Italian and the European Central Bank and American archival sources. And I'm talking about central bank archives. This also because I couldn't get access so far to other key European Central Bank archives, such as Banque de France and Bank of England. It's a very research in the making, as I mean, it's a new research. I'm not an historian of European financial integration so far. And so any comments is most welcome. Also, I missed some data. For this reason, I don't share it with you, but I will provide you with this later on. The idea of this research, the hypothesis, is that during the 1980s, and particularly from 1986-87 to 1992-93, the process of European monetary unification, which of course stepped up in 1979 with the creation of the European monetary system, was indeed was closely intertwined and shaped, influenced by what happened in international financial and money markets during the 80s. It's widely known that, and I use both historical literature and recent studies, such as Adam Too's work on the 27 financial crises, insofar as he touched upon what happened in the international financial markets since the early 1980s. The process, the acceleration of the process of European monetary unification was closely shaped and intertwined with the globalization of financial markets. Basically, what happened was that since 1980, but particularly after 1982, a number of new financial actors and financial products developed. In this respect, I draw upon Harold James' fine-tuning when he argues that monetary policies, he refers to the American central banks, monetary policies promoted to some extent the creation of new financial markets, new financial products, and new subjects, the ascendancy of investment banks, and the creation of new markets such as that of derivatives. Basically, what happened was that a new array of financial products was created. Particularly the rise since the early 1980s, if we look at the Bank for International Settlements archives, this is straightforward, the rise of the so-called institutional investors, that to say pension funds, hedge funds, investment funds, and so forth, but also central banks and a corporation that invested their money in a larger financial outlet, such as the money market mutual funds, which in turn invested this saving into new financial products, such as all of those that financed the real estate market bubble later on the following decade. My assumption is that there was a close interconnection between these developments and the way in which the European technocracies, either at the national level, central bankers of European member states, and at European level, so the European technocracies involved in developing the European monetary system, and at the same time facing off such growing internationalization of capital markets. In other words, the process of European monetary integration, as far as it stepped up since the mid-1980s, and particularly from the Single European Act in 1986-87, and the new European exchange rate mechanism launched, signed in 1993, were deeply determined and deeply influenced by liberalization of capital markets, and that the European elite both contributed to shape the new steps in the European monetary integration and enhanced European the liberalization of capital flows. I tried to take through the archival research and the statistical data that I could collect, that I'm collecting. I tried to make an argument regarding this point different from the existing literature. According to the existing literature, I will quote Barry Eichengreen, for instance. Basically, the process of liberalization of capital market that, of course, began in the UK and the United States since 1980, in the United States with the Monetary Act of 1980, was a process that in some way increased favored competitiveness between different national capital markets, and by this way enhanced competition between the European member states manufacturing and service sector. And this prompted the European economies to came closer to one another, to, let's say, coordinate their manufacturing, production, distribution, and marketing strategies. Harold James goes so far as to say that from 1983 to 1987, this brought, through the liberalization of capital market, so the removal first of capital control, and then after 1986-1987, the removal of exchange control, promoted the creation of economies of scale within the European trade market. So between companies and corporations from different European member states. In this respect, the liberalization of capital markets from the viewpoint of the process of European monetary and economic integration was like a sort of flywheel, something that promoted European monetary and economic and trade integration and production integration. According to my partial, as I said, reconstruction, by contrast, the situation was rather different. The European technocracies and elite, of course, favored and took measure to enhance the removal of capital control and the removal of exchange control. But this happened as a way not to promote, to directly promote European integration, but as a way to set conditions, particularly on the external equilibrium of the European community member state, of each member state of the European community, the stabilization of foreign, of external imbalances, and particularly foreign reserve assets, balance of payment disequilibria, trade imbalances. In other words, the liberalization of capital markets should set should fix and set the external condition that would later provide the framework for a greater and stronger European integration. Of course, this process, first and foremost, was like a way of reckoning that the integration of capital markets by the mid-1980s was already very developed. Not only because a new financial actor and new financial products by the mid-1980s were already much on the stage, but also, in this respect, I provide in my paper as many as I can statistical data. By the mid-1980s, all the main indicators for the increase in international capital flows were signal, tell us that this was a very advanced process, which should be phased off to one way or another, and we will see the way the European elite promoted that. Was something to be phased off in order to promote European integration. And I quote three.
Vous pouvez penser que vous avez 3 minutes pour 3-4 minutes pour conclure, si c'est possible.
Ok, 4-5, c'est possible.
5.
Je serai bref. There are three issues. The first is, of course, the net and the gross capital flows. The other is the difference, the interest rate differential between domestic and international market. I would skip all of the rest. The very argument so far in the paper is that both at central bank, national central bank, have been studying the governor, the paper of the governor of the Italian central bank after 1987. The idea was that market integration promoted by liberation of capital flows would be not compatible with the European exchange rate mechanism. It would brought to speculative attack on the European currencies, and as such, it was necessary to manipulate interest rates, and as such, in order also to stabilize inflation rates, and as such, the process of liberalization should be combined with keeping the European exchange rate mechanism, and at the same time carry out like a sort of monetary policy intervention in terms of interest rate coordination, something that will show up after the creation of the euros in the early 21st century. The paper demonstrates that this policy was shared by the directors of the International Monetary Funds, but created many divisions within the European technocracies, as many saw the removal of capital control as a real threat to the process of European unification, whereas according to others, it should be only a temporary measure. The crisis that many countries which led to the suspension of currency convertibility and to the devaluation of currencies such as the British and Italian between 1991 and 1993, and combined with many problems that unified Germany suffered from, in terms of inflation, external deficit, led to demonstrate the failure of this policy to combine liberalization of capital markets, exchange rate mechanism, fixed exchange rate mechanism, fixed but adjustable, and such a policy to coordinate interest rates. As a matter of fact, in 1992-1993, the solution was to create a new exchange rate mechanism with a widened fixed, but with a wider margin, a 15%, and this is very relevant. My reconstruction is also aimed at shedding lights on the limits, which is something that, again, Adam Tooth stressed just briefly in his book, shedding lights on the limits that cross European Union interest rates posed in the 21st century at the origin, and were at the origin in many respects of the European sovereign debt, insofar as many less developed European member states came increasingly indebted to promote domestic growth after 2003, 2004. I would rather limit my talk to this, if it is fine.